All right, welcome everyone. We are live. We're just going to wait a few minutes to get live on all of the different platforms here. So we'll wait a couple seconds to actually get started. So hang tight, everyone, while we pop up on all the different channels. Okay, see people in the chat tuning in. Good evening, everyone. Good evening. Good evening. You know, put the chat up there while we wait. Okay, cool. Hello again, everyone. Back again this week for our loan officer training series. All right, lots of people tuning in, checking in. Hello, everyone. So as you can see on the screen here, today we're going to go through how to analyze self-employed borrower income. So we're going to wait a few minutes for everybody to jump on and go live on all of the different platforms, and then we will get started. But thank you, everybody, for tuning in on time, early. Wow. All right, cool. Lots of people checking in. Howdy, howdy. Hope everybody's having a good week. Good Tuesday night. We do this every Tuesday, 7 p.m. Eastern Time. A new subject every Tuesday evening. Okay. I think we are live on all of the different platforms, so we are rocking and rolling.
We can bring the chat back at the end if you guys have any questions, but I'm going to take it off for now.
Yeah, absolutely. Drop questions and discussions here in the chat while we go. That's awesome. So today, I guess we'll get started officially here. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined by our president and founder, Nick Hershey, and our sales manager, Jose Gonzalez. So today we are going to go through how to calculate and analyze self-employed borrowers' income. So that's what we're going to kind of do a deep dive into here. A lot of loan officers watching, the whole team tuning in. Shout out to our Mortgage Calculator team. And what we're going to do is I'm going to have Jose talk a little bit about self-employed borrower income and which way we might want to go about this. And then Nick's actually going to do a presentation and analyze self-employed borrower income. So I'll go ahead and turn it over to Jose here to do his thing. So go ahead, Jose. Oh, I think you're muted, Jose.
How's everybody doing tonight? Jose Gonzalez here, a sales manager and also one of the original founders of the Mortgage Calculator. And today we are discussing this is one of the nuggets of knowledge that is going to differentiate the upper level, I'd say the upper crust of MLOs from those that are, just not there. And it is the analysis of self-employed borrowers' income, right? I mean, I was in the business for many years before I actually learned how to do it. It was all lumped onto like that one processor that knew how to do that. And when you're dealing with self-employed borrowers, we're looking at a full doc situation here. There's many, there's a couple of different type of scenarios we could be talking about. We could be looking at our traditional full doc tax return borrower, which is what we're going to look at today, something that would be applicable for conventional loan FHA loan, VA loan, USDA loan, as well as non-QM and any other option that you consider full doc that requires tax returns for a self-employed borrower's income documentation. The other options that we know that we have on our team is bank statement option and P&L for our traditional full doc options. To those we will leave for another lesson. Today we're going to go into the analyzing the tax returns. So typically that's going to depend on if you're running this through automated underwriting for a conventional or agency, let's say for an agency loan, and then you're going by your findings, whether they say 1 year or 2 years for your self-employed borrower. A lot of that's going to depend on risk-based, so on LTV and credit score. Or if you're running it through non-QM, where it's manual underwriting and you pick your program. So you don't have to see what automated underwriting says. You just pick your program according to what you need. In this case, let's say we would always love the 1 year tax return option. So today we are going to analyze some tax returns. Nick's going to be doing the analysis on the I don't know if he's going to use the Freddie Mac or the Fannie Mae form, because they are two different forms depending on where we're taking this. Non-QM, I believe, uses always Fannie Mae for their self-employed borrowers, but you always got to look at their individual guidelines as well. But when they're analyzing and looking at the tax returns, they're going to be looking at a lot of those things. So Nick, why don't you go ahead and show us what you got there?
All right. Yeah, I prefer the Freddie Mac form myself. I just feel it's a little easier, and typically that's the one we're gonna use if we're gonna go full conventional. We're probably gonna try to go Freddie 1 year or 2 years. So
yeah,
we start with that.
That's a really important point there. I did forget. That's one of the things I always make a note in my training when I'm talking about the differences between, with that, not all conventional loans are the same. And we talk about the differences between Fannie and Freddie. And I always recommend for the self-employed borrowers to go Freddie, because as you're going to show when we analyze at K1, you're going to be able to use the ordinary income versus distributions when the business has liquidity. That's the big one there.
Yes, sir. So I'm about to share my screen here and go through a couple things before we get started. So I'm going to set up a little scenario. It's kind of hard to do an example, so it's going to be a little awkward, but we're going to use something that everybody knows, which is the presidential candidate's tax return. So I'm going to drop this link that I put in our training for our team that I've used a couple times. And I'm going to put it on our YouTube, since most people on our YouTube. And I'm going to actually, in this example, I looked through everybody on here. Most of the time, it's only when they're running for president. So the best example we have is Bernie Sanders on his 17 and 18. So he had the most actual self-employed income of all the candidates here. Not trying to pick anyone or discriminate on anyone here. This just so happens to be the two that work best. Then the other tool I'm going to use for our example here today are our self-employed borrower calculators. So I like to use this Enact tool here. So if you come to this page here, it has all of the forms that we were just discussing, me and Jose. It has the 1084 for Fannie Mae. It has the 1084. This is the PDF. I like to use the PDF forms. That's just my personal choice. There's the 1084 Excel sheet here. And there's the Freddie Mac Form 91. I personally prefer the Freddie Mac 91. And this is the 22 and 21 version. So know that when you land on this page, which I'm about to share with everybody in the YouTube, this is the, look at the years here. Just pay attention. This is the 22, 21 version. So you have to have 22 and 21 taxes for this. So if you don't, and especially in our case, we have a super old tax return because this is way back when they were running. We have to scroll down here to the archive version. So if you open this archive version here, I think the default is it's closed. Just click this, it'll toggle open, and you guys can all follow along. There's over 100 people watching here. It'd be nice if you guys follow along. It'd definitely be helpful for you as you learn. So definitely click those links if you can get them there on the YouTube. So what I did for this example is I came down here, scrolled all the way down to, shoot, where was it? I found the 171891 right here. I click this, and that is going to be my example that we're going to use for this. So go ahead. I guess I can go ahead and click it. It opens up, but I have one pulled up here. So let me pull this up. And then obviously I downloaded the tax return, the 17 and 18 tax returns. So first off, I just want to scroll through this real quick just to kind of set the baseline and so everybody knows what we're looking at. A lot of people probably haven't seen a full tax return or some of these pages. Everybody's tax return is different, obviously. So I want to just scroll through this and highlight the pages we're going to look at. And then we'll go through the actual analysis here and start plugging in some numbers. So first thing we'll put here is Bernard Sanders. And it's probably going to be Jane as well. Jane Sanders. And we don't know a property address, right? This is a TBD, right? We're doing a pre-qual for an imaginary person. But this is the only data we can have. And let's go ahead and scroll through this and see what we're going to do. So the one thing we're going to see is that there are wages. So we do need to look at this first page, obviously. Most of this other stuff we're not going to use from the first page. So we'll scroll through this. We see that they have a Schedule A. I know it's probably really small for all you guys on the thing. If I zoom in anymore, though, you won't see much of it. I think this is about as far as I can zoom. I can probably zoom this one a little bit here, actually, on this side. Let me try that. And maybe we could get one bit of zoom here. Let's see. Yeah, let's fit width. I think that's probably the best. Yeah, we'll stick with that. All right. This Schedule A, we don't actually use. Schedule B, we will use, but doesn't look like he has a substantial amount. I wouldn't fight for a borrower to get $183 a year, right, Jose? Like these are the little battles we don't want to wage, you know. So just know that it's there, obviously. Schedule C, this is what we're looking for, right, guys? This is exactly what we're looking for as a self-employed borrower. And a lot of times it's hard to see, with husband and wife, a lot of times they don't specifically have a name here, and you have to see the social. So just note that, make sure it matches because, a spouse, in this case, husband and wife, and if this name was not there, it's hard to decipher which one it's for always. So make sure you match the social as well. But in this case, it's redacted, of course. So this Schedule C, we're going to have to pay close attention to this here in a second. Scroll through this. This is the second page of the Schedule C. And boom, we see there's another Schedule C. So Jane, spouse, is also an author. So obviously this social would be different because this is hers. But we need to pay attention to both of them, okay? This is the second page of her Schedule C. And then boom, Jane is also a Vita commissioner right here. So this is important to note also. And this is a Schedule SE. We're not going to actually take any data from this, but that's good to note that it's in there. This is alternative minimum tax. We don't do anything on this. 89.59. You don't see that anywhere. We don't see this anywhere. We don't see this anywhere. These are numbers that are input other places on the return, but we're not using any of these for our calculations. And, it looks like he amended it. Great. He amended his Schedule B. Well, that's a little complicated, Jose, but that's an interesting twist. I didn't even notice that when I was setting up this example. Obviously, if you load this up to an underwriter, guys, you're gonna get hit with this. But I wouldn't have submitted the Schedule B income into the file anyway, right? But if you did and you didn't notice that there was an amended copy, I don't think it changed by much. But that's something that could trip you up. It's a great little thing there to know. All right. So that's that one. Now 2018, remember, people change. So this was another reason I chose this as a good example because I believe it does change around a little bit, right? So let's check this out. Up here, there are W-2 wages, which we have to pay attention to. So we're going to have to check out the first page for sure. Schedule 1 doesn't really have anything. Schedule 4 doesn't really have anything. Schedule 5 doesn't really have anything that we use. 2210 doesn't really have anything we use. Estimated tax worksheets. Schedule A, deductions. You don't have to worry about that. Schedule C. So it changed here, though. Notice it's a different place of business or company name. So us as loan officers, we got to pay attention to this stuff. For him as a person, right? He writes books, so it's it's an easy story to connect those dots. But this is technically a different company than what it was before, guys, too. So make sure that we're looking at this as we cue in of not only who it's for with the social as well, but also notice that name change. Maybe it's the same. Maybe it's the same company. Whatever. Just know that our underwriter is going to be seeing that just like we are. Second page of that one. Another Schedule C. Now it says music royalties. Interesting. So obviously that's a new business, right? We didn't see anything last on the 17th with music royalties. So this is technically a new self-employed business, but I would guess that this is just the audio version of the book and the music rights from that. But I don't know for sure, right? We would need to get some information from the borrower. We're still going to do the calculation, but just know that we're going to have to tie these threads together, right? That this is still the same activity, right? Another Schedule C, book royalties. So he sold his publishing rights now, right? Which is obviously the same activity as it was last year, but now it's getting big, right? So he sold his publishing rights, and now now we got some bigger numbers here. So same activity. I'm sure we could use it all as loan officers once we tie it all in, but technically this is a different entity. It's obviously the same royalty or same copyright that he created that he now has multiple income streams from. So this is a tricky one. This is why I love this. This one's a perfect example. One Schedule C turned into 3 already, right? Probably the same activity, but we still need actual documentation to tie that thread together. This was the second page of it, and looks like this is just the self-employed, and then the Medicare. 8960, we don't need that. And that's it. So not super complicated beyond the Schedule C. So again, this is why I chose this example. The last one we did, Jose, was kind of a poor example, right? So this is good because these are just straight Schedule Cs. And it's like the same activity that all of a sudden turned into other activity. So we would need all kinds of letters of explanation. If there's an actual business called Bernie Sanders Music Royalties, probably not. It's probably just he gets a check, and that's just another form of income from a copyright that he created, I would guess, but we have to get all that documentation. So let's get down and dirty now. So I just wanted to go kind of an overview. Jose, any comments before we start of kind of the things that I maybe missed or any other things to look at before we go in?
Well, just in general, are we going 1 year or 2 year here? Are you just setting it up and then running it? Is this going to be, well, I guess my question is this going to be an automated underwriting loan?
Yes. So, I mean, I'm going to do the full calculation and then we're going to talk about that at the end. And that's why I love the Form 91 because it quickly spits out a 1 year and a 2 year right away. That's why I love this form.
Cool.
So
we'll save that for the end then.
Okay. Other than that, good to go? All right. So let me start putting some numbers in the boxes here. Okay. So let's I don't know what his W-2 is. I don't have a copy of it, so unfortunately can't put the name of the business. And this is typically if it's W-2 from self-employment. Remember, we can always use W-2. I would imagine this is from him being a senator or whatever it is. But typically this form is for W-2 income from self-employment. In this case, just so you guys can see how the form works, I'm going to use it here. And especially because we're using both husband and wife, right? They're co-applicants together in this case. So we're going to be able to capture all the income on the tax return regardless, right? They're co-applicants. We're going to be able to use all categories. Again, for W-2 income from other employment, we're still going to need, pay stubs and all the regular stuff you guys are all used to for W-2. So just because this number's here doesn't mean that we don't need current pay stubs, and they're going to do a current pay stub analysis on that stream of income. Okay. If this is from self-employed borrower, this is what you'll get too, by the way, and you'll still need the pay stubs. Super tricky there, right, Jose? When the pay stub is from the activity. So you notice this said IRS 1040 line 7 W-2. So that's right here. And the next one we're going to look for Schedule B. So remember, he did have a Schedule B and a Schedule A, but we don't use that for our self-employed borrower income. Go straight to Schedule B, and notice our little calculator tells us exactly what we need to add. We're going to get our recurring interest income from line 2, which is this. So again, as I mentioned earlier, this is probably a battle we don't want to fight, but just for the sake of the video and the calculation, we'll put it in there. Try to get every penny. And line 6, there's nothing, so we'll put 0. I always encourage our team to put zeros in the boxes so you know you actually did the calculation. Blank means I didn't do it. Zeros means I did do it, and there's nothing, a 0 there. So that's just kind of my pet peeve there. So if I review your calculation and I see it blank, I don't know I don't know if you put a 0, if it's there on purpose or not, right? So please, team, put a 0 there. And dividend come from self-employment from 1120. We're not going to have that, but we don't have it to find anyway. But in that case, I would leave it blank because I don't have it, right? And I would know that I don't have it. I don't want to put a 0. That would assume that I have this. So in this case, I don't have a form 1120 at the moment. And the next one we're going to look for, which is the super important one, is the Schedule C. So let's scroll down, and boom. The next one we land on is Schedule C, and we're going to put the name of the business here. This is the proprietary, but this is the actual business name right here, our business activity. So you can put, I would put just a little bit of both so that I know it's for both, but just know that they're going to want to know what the actual name is. So if it's like an LLC, it needs to be actually listed here, right? I'll put both of this because the spouse is involved as well. So we'll put the spouse for her on hers. And in this case, we're going to look at, first off, line 31 here. I know it's really hard for you guys to read. I can probably zoom this one in a little bit more. Is that better, Kyle? Okay. So line 31, right here at the very bottom. Let's see if we can zoom in a little bit more. It's really hard to read. That's line 31 though. 855,484. Boom. Line 31, 855,484. Line 6. Notice that's here. Again, always get in the habit of putting 0 since we know it's actually 0. Line 12, it's blank, but that means 0. Line 13 over here, I don't know if you guys can see where I am, right here. Line 13, 0. Line 24B is the next one we look for. 24B is actually $122. He took someone to dinner. No worries. And then this one is on page 2. Notice here, section C, page 2, part V. And this one is line 30. And they have to have that extra form, but line 30 is blank here. So we're just going to put 0. If they claim that, they usually have another form. And then this business miles here is on, hopefully you guys can see it says page 2, part 4. So both of these two missing pieces are on the second page. Very common. A lot of people don't panic if there's no second page. That means there's no values there. Accountants are lazy. Some accounting packages don't print the second page if it's all blank. I hate that because then we're left with this question is, does it exist or does it not, right? But just know, don't panic if there's not a second page as long as everything else looks normal, right? In this case, there is a second page. His accountant is just not lazy, right? So it's all blanks, but this is a non-lazy accountant, which gives us as loan officers a sigh of relief because we know that 0 is 0 and we don't have any, hanging chads there. So boom, 0 and 0. We know that's there. Non-lazy accountant. Boom, beautiful. All right, next one. We're done with this one. This is the income on this one. Now we're going to scroll down. This is also why I love this Form 91 for everybody watching, because we get 2 Schedule C slots per form. So in this case, we can actually put both spouses on the same if they were both pretty simple and we're both just book authors, which is almost what they are this year. So let's put Jane Sanders, book author. I spelled today, sorry. And 2017, line 31 at the bottom, she claimed 106,250. If you guys can't see that, so 106,250. Line 6 is 0 for her. That's up in here, guys, if you can't see it. Line 12, we go over here for the next couple lines. Line 12 is over here. It's hard to highlight it, sorry. Is 0. Line 13 right below it is 0. The next one we look for is line 24B. She didn't take anybody to dinner. It's 0. These next ones are on the next page. The one we got to go look at before we go to the next page is line 30. It's 0. And then we need to go to the next page. So again, great. The accountant wasn't lazy here. It's all zeros, but they put this page so we could see it. So boom, 0 and 0. Love it. All right. Now this form skips to Schedule D. Let's see what we have next.
Excuse
we
me,
have
Nick,
another Schedule C. What's up?
could you elaborate a little bit there on that amortization category? Because that one
I
can
want
be
to see.
confusing.
I think
for
we
some
have
people.
one here. No, we don't. We have one on the next year. Okay. So let's go back up then. Okay. So you're talking when we put this. So Jose's talking about this, guys, which is Part C, page 2, Part V, which is right here, other expenses. Okay, so this is what we're looking at. So before you type this in, just pay very close attention. What Jose is highlighting here is that you can only add, there'll be line item expenses. You can only add an expense if it has the word amortization or the word casualty loss. No other words or categories can be added back. So a lot of people just total up a bunch of stuff there. You can't do that. Right here it says only add back amort or casualty loss. That means if that word exists, you can add it. If that word doesn't exist, you can't. If this word exists, you can add it. If it doesn't, you can't. All right. Is that
Exactly. Very, very important. On point.
Yeah. Okay, cool. Yes. On this year he has a couple filed of a couple expenses, and it'll be a better example because we'll not add anything, right? Instead of someone might make the mistake of adding that, we're not going to make that mistake. So hopefully we'll come back up again here in a second. So now going on to this though, there's another Schedule C. So now we got to figure out what we're going to do with this because we don't have a slot for it here. So really what we have to do, let's see, where's my, I think I had another copy here. Yes. So I have another, and now I'm going to have 2 copies of this form. So one for the first 2 Schedule Cs, and then now I'm going to have this other one for, oops, I scrolled too far, another Schedule C. So what do you do when you have too many Schedule Cs? You just have more forms. Same thing when we have the Form 92, which does our Schedule E's for real estate investors, which will be another, when we do this again, Jose, we'll do someone with like 50 properties. We'll find someone with an old return. One of these presidential candidates got like 50 properties. And we'll run a crazy Schedule E where you have to have 5 or 10 copies of the Schedule E forms. But in this case, we're not going to go too crazy. But this is Jane Sanders as the VEDA commissioner. All right. And this is 2017, line 31. Let me zoom this one in a little bit for you guys. Not too much. Right there. So 2017, line 31. Nothing. $50. So kind of worthless to do this whole exercise, but we got to do it. Line 6, 0. Line 12, 0. Line 13, 0. 24B, 0. And these are the second page. This is line 30, 0. Let's check out the second page. No, nothing there, and nothing here where the vehicle stuff is. So 0 and 0. So this is a time for these little tiny weird things. I would not add this income for the borrower, right? We don't want to have to prove this income for this borrower to capture $50 over a year. That's $4 a month, right? That wouldn't be worth 50 documents back and forth and stuff like that. So those are the little battles we don't want to fight. So normally I would probably just not do this, but when we go to 2018, they're going to need another page anyway. So as we scroll through this, though, there are no other sections that we needed to pay attention to. Besides, they did refile an amended return, which trips us up, which if we see an amended return, now we got to go, oh, okay, what changed? It appears they only refiled their Schedule B, so let's go back to our Schedule B, which was on this page, and just make sure, again, we don't get tripped up. I didn't want to claim that anyway. Okay, it's the same amount. Why did they refile it? They checked the wrong box or something? That's weird. Okay. Same amount. Maybe they just clicked the wrong box or something. But yeah, we're done. So that's 2017. So we're done with that one. We're good to go. Now let's scroll over to 2018. Maybe I can zoom in just a tad. Kind of cuts it off. Yeah, that'll work. Okay. So 2018. Boom. First, we grab the, it's line 1 in this case. I don't know why they say it's line 7. I guess they changed the form or whatever before they changed the thing. 133.3 and Schedule B. Let's see if he has it this year. That's the first one we got to worry about. Nope. That's all estimated taxes, Schedule A, and it goes right to Schedule C. So he doesn't have any dividends. Again, another reason why we wouldn't want to fight that battle, because there isn't even a form. So this would actually, I would leave this blank to indicate that he doesn't even have one this year. And then now, where is book author? So we're trying to find the second year of book author. You guys see book author here? This is where you start running into trouble, right, Jose? The underwriter's like, wait, who's this? You changed the name. Did you change the business name? Is it the same business? Is it an LLC? Is it a sole proprietorship? Is it a C Corp? Is it an S Corp? What is it? Now we're getting some inconsistencies. However, pretty sure one little letter will turn book author to book royalties, right? A book author pretty much always turns to book royalties if they're successful, right? A copyright of a book turning into successful money-making venture is going to generate royalties. So I think we can capture this. I'm unsure even here, Jose, if I would put this under this same Schedule C here. Are we going to average this with the other 2 years, Jose, or what would you like to do with this situation where it seems that this activity split into book royalties, music royalties,
No, but
and book royalties to another publisher? So he split different publishing rights, it appears,
but
the same activity.
Which is the one that's generating the money, though? Out of those, are any of those Schedule C's the one really generating? Because that's nominal amount of money there.
Yeah, this one's got not much. This one's only $110 for the music. The music's not going very well yet. And this is where all the money is at, under Macmillan. So Macmillan's the big publishing deal that he did.
Yeah, I mean, yeah, I guess if you're going to consider them all as publishing related, I don't know what the other one was. One of them was the royalties you were talking about, right? The author.
This is book royalties. So it looks like he just has 2 different book royalty deals. So this is the music rights, probably to the audio version of the book,
yeah,
I would assume. And then this is the book royalties to Verso, which is maybe a different publisher or a different channel, maybe overseas publisher. That could be his overseas rights to his book, etc.
Yeah, I mean, well, there are definitely royalties, but I guess at that point you would need to note if you're doing 1 year or 2 year option, because then if you provide those others, they're independent streams according to how they're being presented by the accountant, and you're going to have to provide whatever the findings say if you're going automated underwriting. And, I guess.
So in this example, though, let's put this as the continuating activity, right? So I think that'll be the most I want to stretch this is to try to say that book author turned to book royalties to McMillan. This is the same activity, right? And then that way we can have a simple calculation here. So this is a challenge, guys. These are the types of challenges we have to deal with. Obviously, he made the money. Obviously, it's the same activity, so just probably take some documentation and some letters of explanation, right, Jose? Letter of explanation for letters of explanation. But let's add it here. So let's keep it simple. We'll just use McMillan and consider that the continuation of book author. So I'll call this book author / royalties.
You know, what we would have to worry about, where we would not have the choice like we just did, is if there was a loss. Because if there was a loss, then it would have to be included if we're going the self-employed route.
Correct. That's a great point, guys. So when we say we don't have to win that battle for that $180 of royalties of dividends and stuff, that's because it's a gain. When those things are losses, you're going to get hit for no matter what. You're going to have to provide info on it, right? That's a great point. In this case, line 6, guys, is 0. Line 12, 0. Line 13, 0. 24B, 0. And that's on the next page. And line 30, 0. All right, let's see on the next page. Great, the accountant put it, and boom, look, great point here. The accountant should have put, see, this is a great point. Okay, so check this out. If this accountant knew mortgages, this accountant would add editing fees as a startup cost for the company that you can amortize. So I know for a fact that you can amortize that fee, right? Because that's a straight up startup cost for a book. How do you make a book? You edit it, right? How do you start a book? How do you start a book business? You create a book and you edit it. So that's a startup cost for sure, 100%. If the accountant, it makes no difference to the accountant what he categorizes that expense as, but it does for us, right? So this accountant needs a little bit of a prod to say, hey, I want this to be a startup cost, so I can put amortized startup cost $10,000, but that $10,000 will be amortized over 5 years typically for a startup cost. So the accountant will need to do their job. So it'll be $2,000, but we can use it, which is better than $10,000 we can't use, right? $2,000 a year for 5 years is way better for us that we can add back than, it's the same difference to the accountant, the same difference to the taxpayer. It's just play on words, right? But other things that people expense, you can't. But I know for a fact, this is a perfect example of an accountant saying one thing and not knowing mortgages, and that's fine. They don't care about mortgages, but we care about this, right? So if we're with this borrower, we might want to say, hey, before your accountant files your next year, make sure they categorize it in a different way that's more suiting, right? And proper, right? It is proper to add this as a startup cost and amortize it. But this is 0. In this case, we can't add the 10,000 because it doesn't say amortization. Okay, so I'll have to put 0. Unfortunately, we can't get $10,000. Makes a pretty big difference, guys. Check this out. So the business miles is right here. It's 0 also. But if we did get that $10,000, notice, he made a boatload of money. But if we were able to capture that $10,000, it adds it directly to our income. Big difference, guys. Big difference between expensing something. It makes no difference to the accountant, no difference to the tax at the bottom line. It makes a big difference to us when we do this calculation. So I do want to bring that up. Anything else, Jose, on that one?
No, just can't stress enough what you're stating there, that the key here is that this is an accounting phrase, amortization, which is the recapturing of the startup cost of the business. And that's how they have to categorize it in order to be able to recapture that, because that's what the guidelines state. The guidelines have like that. You can recapture amortization of the business startup cost. And if it doesn't say that exact word, you're out of gas.
Why don't you explain this a little bit, Jose? Because I've never seen this, but I think you have a couple of times. So casualty loss. Can you give an example of that?
Yeah, definitely. A casualty loss is you have a loss in your home or your business, whatever it is, that's not covered by insurance and out of pocket, where the insurance didn't cover it. right? It's a casualty loss, and your casualty insurance may have had a high deductible and say, hey, no, first 10,000 is out of your pocket, or first 5,000 is out of your pocket, or you maybe didn't have insurance and you had to go all out of pocket on some type of a casualty loss, like a house burned down or some other kind of a situation that you would normally file an insurance claim for, but maybe you didn't have insurance or adequate coverage, or the claim was denied. Then you would claim that as an out-of-pocket casualty loss on your tax return.
So that's a great point, because look, they would want to claim that. So say the borrower wanted to put, instead of 10,000, places 100,000, right? This was a big claim. That makes a big difference. That would show that they made 281. So in this case, let's do that example. So in this case, let's say Bernie had a house burned down and he claimed 100,000 casualty, and we only had 281 of income to claim because he wrote a bunch off. But we come down here and we see the magic words casualty loss and the magic number 100,000. Boom, 100,000, because we know as a bank that wasn't a real loss. That was him, a paper loss, right? He just got screwed, right? Wasn't his business losing money. It wasn't his business activity going out of business. It was something unfortunate happened. So now we got that same amount of money back. So it's a huge difference there in Jose's example, because they're huge losses often, and they're one they don't amortize those usually, right? Jose, that's one time when one bang.
Yeah, that's just one shot deal. You lost, you got hit that year, and had the exposure. You get to claim it as an expense.
Yes, sir. Let's set this back the way it was and continue the example here. So in this case, we skip those other ones. Let's try to make it easy. These other pages do not matter for our calculation. They're not in here. So the other pages we do need to look at, just so you guys see. If we see a Schedule D, we got to stop. We got to calculate it. If we see a Schedule E, we got to calculate it. Note that this form is only Schedule E royalties, which is interesting because you hardly ever see those, but all these politicians got royalties, which is interesting. Almost every one of these politicians has a royalty Schedule E, which is very rare. So very rare do you see this and have to fill this in, but that's only if it says royalties. Every other time you see a Schedule E, it's going to say a property address, and it's going to say a rental property. You guys have all seen those, hopefully. That's on the Form 92. Okay, so when you see the rental properties, just know that Freddie splits them up into Form 91 and Form 92 for the rental properties, because it's a whole different ball game on the rentals. This Schedule E is royalty Schedule E. Maybe we'll do another presidential one and do the royalty one, Jose. Schedule F. This is only for people like Jose that have a big plot of land, right? Very rare, but people that have it, that it's there, and it does actually generate steady income for them typically, aka losses that we can capture back essentially. So.
Well, we were discussing it at the recent conference we were at with one of our peers that's from Indiana,
yeah,
and he was saying, well, actually, in my neck of the woods, like most of the, he gets a lot of people that come that when they're full doc that have farms that have the Schedule F in Indiana, but definitely not in Miami.
Yeah, Jose's kind of the only guy in Miami with it. Yep. All right. So this one's hard to do, or very, very uncommon. So just don't worry about it. Just go line by line if you see it. Now these ones are harder. We'll do these ones in depth later. Obviously, these take a lot of time because you need both the borrower's return and the actual partnership return. So this is for a 1065. That's a partnership return. That's most LLCs. If they're a real LLC, they're going to be a 1065, a partnership LLC. So a single member LLC is not necessarily the same. That's not a 1065. So like a full LLC with partners would be a 1065, and you would have to get the Schedule K1, which sometimes is with the borrower's tax return. So sometimes you'll get this, but to finish this form, you must get the entire 1065, because there's 1, 2, 3, 4, 5, 6, 7, 8 pieces of data that you need from this filing. So it's impossible to finish a self-employed borrower if you don't have a 1065 for that company. Scroll down here, same thing, 1120S. This is for an S Corp, 1120S. So if you see an 1120S being referenced, so typically you'll see these referenced on their Schedule E, but it'll be for their K1s, right? We'll have a line for their K1s, but know that we need the K1 in hand to get these two pieces of data. Sometimes this is on their personal return, at least these numbers are, but you must get the S Corp 1120S return in order to type in these pieces of data. So most common mistake from our loan officers that are newer, that are starting, is when we get to disclose the loan, get ready to go, they have the most of the numbers, but we're missing this entire return, which is hard to get, just because we have to have it for these numbers in order to finish. So make sure you get the full form if they're filing a full separate business, right? Schedule C, remember, let's go back to the Schedule C. Schedule C, totally different ballgame. This is a sole proprietorship. This is not a real business, right? This is just a person doing business as a person. They can still sometimes have like a fake LLC, like a pseudonym type LLC, but a real LLC is typically going to be this 1065 up here, right? They're not going to be filed on so I passed it. It's 1065 form. They're not going to be filed on a Schedule C. This is only for sole proprietorships. Okay. 1120S often are called, INC, incorporations. So make sure you get the full 1120S form and the borrower's K1. Now, 1120, super uncommon. That is for a C Corp, not a Schedule C. Very different thing. So a C corporation. This is like a big corporation, like NASDAQ type corporation, right? A C Corp. So this is very, very, very uncommon. And the thing to note, is the note in here, Jose?
Yeah, I'm not sure if it's there. I have it in the like a training guide that's attached to from one of those MI companies that I've picked up.
Yeah. Anyway, the trick here, guys, is there's you only have to hit a borrower on 1120 if they own 100%, at least on Fannie, Freddie. So don't let the underwriters bully you around stating that you have to provide documents. They're going to ask for it, but technically, if you read the guidelines, you only have to provide info if they own 100%, because otherwise a 1120, a C Corp, holds its own losses. All other companies are pass-through losses. The losses go to the borrower. Incorporated entity, a 1120 C Corp, they call it, right? This is like a stock entity, right? There's no pass-through people. This is like stockholders, like a publicly traded company, and those losses stay within that company. They never pass through to those stockholders. So that's what's very different about this. The only time that changes, where you can pierce it, is because the borrower would own 100% of that. So owning 100% of it, you technically don't get the protection of a C corporation because you're not insulated from it. You can't own 100% of the shares. So that person would need to give 1% to someone else in order to fully protect themselves as a fully separate entity. So very tricky there. You will probably never deal with it. But
Well, it all depends, though, because you get all these buyers, and every now and then you get one with that has the C Corp, and man, like you said, don't let the underwriters bully you, because they will. They're dealing with a bunch of files. They're going full speed ahead, 110 miles an hour. They're gonna usually treat it like an S Corp, and you're gonna have to push back like a locomotive. I mean, really hard, especially if you're dealing with some of these faster moving investors out there that have a lot of newer underwriters and have like a pre-packaged process that whatever they do. And then, you got to be doing a lot of escalating of the escalations, if you know what I mean. So, yeah, man, this is one where once you master this, you will be the loan master. Once you do this, I'm telling you, and you push it back, because when you push it back at these underwriters, and like they're gonna say, "Wow, nobody's told me that before." Oh my God, and then they'll escalate like the SVP of operations that comes back and says, "Yeah, they're right. Let's deal with it." They may ask you for the tax returns of the business. That's where it gets a little hairy. Because just imagine they're asking you to ask the stockholders of the company to authorize the release of this private information on a privately held company. Um, Presents a lot of challenges there, right there. So that's probably the biggest challenge on that. But S corp is passed through based on the percentage of ownership. That means if there's losses, you get your proportionate share of the losses, and if there's earnings, you get your proportionate share of the earnings. That's where it can get pretty scary on one of these C corps that has, you know, $400,000 or $500,000 in paper losses, and underwriters trying to tell you your guy doesn't qualify anymore because of da 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 da. And I'm like, oh no, wait, that's not right. Now that roll up the sleeves and the battle begins.
Yeah, now the boxing gloves are out, right? Now the fight begins. So yeah, just I mean, just it's hard to get in front of too, because once the cat's out of the bag, they're still going to want to see something. So it's just you just got to understand it. Really, is the only thing you can do is just understand it and know your guidelines. But you probably won't get there, you know. If you do, just stand firm. But let's go down to the rest of it. We're almost out of time here for today to keep it under an hour. The summary. So now that we got all the data in here, now we have the summary. Let me go ahead and just full screen this so we can see it a little bigger. And you'll see here that we had the W-2 income. So we got those. I didn't want to fight for the Schedule B, so we'll probably erase that eventually. This was the one that continued. This was his wife's one, which didn't continue. So we have to basically take this one out, right? It did not, this activity did not continue. So realistically, this is declining as well. So is this. Everything's declining. So we're going to have to go with 1 year regardless. 1 year's not an improvement in this case. Jose, 1 year's the worst case. So we actually don't have to delete anything. So scroll down here, it sums up all the businesses, and boom, this form automatically added up our totals. So at the bottom here, it tells us to divide it by the number of months. So since we have 2 years added, this would be our 2-year average. But since we know we're declining in totals and we're declining from here to here is non-existent, so we would never get this income ever. Here to here is super declining. We'd never get 855. We'd only have to go with a 381. Here to here is declining, made less on the W-2, so everything is declining. So we're actually not going to be able to get anywhere close to the 24-month average. So in this case, we're going to have to use the 1 year average. So we're going to say manually input the data. So that's why I love this form too, because it gives us an option to say, okay, there's your 2-year average, but what the hell are you going to do, right? What are we actually going to use in this case, right? So in this case, we know we're going to have to use this number. Oh, we're going to copy. Let me just type it. 514873. So that's our income. We're going to have to put the number of months. In this case, that's the 1 year, so 12 months. And we can click this button, and boom, that's the income we're going to get there. So in this case, we would save this form. You can click save, or you can just click download, you know, with your changes. I would just save this as my info. And we're going to type this number in. So just so you guys can see, let me stop sharing my screen for 1 second and pull up my example. There it is. So that's the number we're going to type in to our LOS, right? So this is our LOS Encompass, obviously, that we use here. So most of you guys probably use this or similar. So this is our John homeowner, you know, Fannie Mae test file, whatever. So say this was Bernie Sanders, and this was, you know, book deal, whatever it was, whatever the book deal / author was the activity, basically. So we're going to have to come down here when we're doing self-employed borrowers. Let's delete this for the example. When we're doing a self-employed borrower, we're going to have to say we are the business owner and we have an ownership share of 25% or more. And we're going to make, where was our final number there? Where's my calculator? 42,906.08. 42,906.08. That is our income for Mr. and Mrs. Sanders. This is our self-employed income that we're going to be able to use. Obviously, we want to break that out by all the different categories. But at the end of the day, this is what we would use to, offset our DTI and all that for our calculation. So we have to, anytime a borrower has a Schedule C or a Schedule E or any of those schedules we just saw, if you guys read the Fannie Mae guidelines, you must have tax returns. You'll get lucky if you get 1-year findings, but you must have tax returns 1 or 2 years. You must do that calculation. You must type the numbers from that calculation into these boxes and then run Oz, and then Oz will tell you what you're going to find. So that's basically that. Jose, you have any? I want to pull up one more example. Do you want to talk about anything real quick for me while I'm pulling something else up?
Yeah, definitely. As you were showing all the examples of especially with the 1120S, and I see some questions going up there in the chat regarding 1065s and stuff like that.
Yeah, why don't you answer the question here while I do this? Yeah.
I would like to first state that it's really important when you're doing your whole loan analysis that you ask the borrower how they structure their business, right? They're self-employed, and you are because and they say I have an S corp, so that you need also 1120 S's, which is the business tax return for the S corporation. If they have a C corp of which they are 100% owner, we actually one of our MLOs, Brad, one of our senior MLOs, had somebody that he and his wife are each 50% owner of a C corp. But the irony, and I'm sort of going digressing a little bit, still on topic because it's one of the questions also in the chat. The irony is originally the file was going to disclose it as a W-2 file, right? And then we're looking at it and I'm like, how is it possible? Both of these people work in the same place and they make the same exact amount of money every month. I think that they're owners. Do we have the W-2s? No. Okay. So he did a little bit more research, probed the borrowers who insisted they were W-2, probed the borrowers a little bit deeper and harder. And yes, they admitted that they had 100% ownership of the C Corp. And in this case, the C Corp added some extra income to them. It wasn't a loss. Actually, I had like $2,000-3,000 a month in income. But the irony is that you don't want that to be found out when the file is an underwriting, and all of a sudden you're getting hit with stuff that, in this case, they're actually 100% owner. What if it would have been $100,000 loss on that C corp? Then it's a really tough situation. So always ask the borrowers what their structure is, so the documentation you need to ask for, because it's not always obvious. I've run into scenarios where the MLOs are trying to do the calculation. The calculator is saying it doesn't line up. It doesn't line up because the borrower has an 1120 and they're trying to grab income just from the 1040 and extrapolate income from other sections of the K1 and the 1040, but you have to go to the 1120 to get all the breakdown. So things like that if you get off on the right trajectory from the beginning, you're okay.
All right. I did just want to point out that when it comes down to what Nick was actually doing with the calculations, you see it broke down to pretty simple. It tells you right there on the calculator, put line 31 here, right? Line 12 here, whatever it is. So, definitely pretty simple when you break it down as far as putting the numbers into the calculator. So don't get too overwhelmed because it tells you exactly where to put each amount, right? Literally copy this with the tax return and paste it into this box.
So let's answer a couple of questions here. David wants to know, is a single member LLC considered a sole proprietor and files a Schedule C instead of a 1065? Absolutely. 1065 is a partnership report, only required if there's a partnership, because then you show you break it down, and then you have the distributions, and each partner gets a schedule, whatever, K1, whatever they get, and shows what the amount of money that they receive from the partnership, and then that gets filed in the Schedule C. So I don't know if they're collecting Social Security income. Let's see. So
do you want to go through all the questions formally, Nick, or do you want to do something?
Yeah, go for. I'm trying to do the example here. It's just taking a minute to process.
Okay, I just didn't know if you wanted to spotlight the questions there when we were going through them here.
Do you want to do that, or just go through them and pick out the ones that are actual questions? Because the next one would be April wants to know if it's the same activity but different publisher name. I guess she was talking about Bernie's different book editing type functions. Could you get a letter from the company or something to confirm the business name change? I don't know if I understand your question. You're assuming there was a business name change. He just had three different businesses going on, three different streams that appeared to be related. Maybe there were different deals, but I don't know if it was a name change.
But if there was a name change, I guess a letter of explanation would probably solve that.
Probably would require a letter from the accountant that prepared the tax returns. Usually would be the simplest and most direct way. Now, Amber was asking, she wanted us to elaborate on bonus depreciation. I'm not sure what bonus depreciation is, because she says it looks like you can add it back for income for Schedule E real estate, but you can't for self-employed. I'm not really sure. I'm trying to. Okay, depreciation is a term that you can always recapture, and it's depreciation on your real estate as well as depreciation on your business, as long as you have it listed and on either the 1120S or on the Schedule C if it's a sole proprietorship in the specific depreciation section, and you can add it back in the Schedule E income calculator, which I don't think Nick went over through one today. It shows where you can add back depreciation to the expenses. So depreciation is definitely an added back expense. And yes, Amber, not all self-employed people are Schedule C. Obviously, as you saw in the tax return, some are S Corp and some are C Corp. And the LLCs, we already discussed single member versus partnerships. And the K1 and how it affects Freddie Mac and Fannie Mae loans. So, and I think that's pretty much it for the questions, I believe.
Okay. All right, let me share here real quick. Just.
And Amber clarified, bonus depreciation is taking the entire deduction in year one.
We can depreciate deduction that's listed in the line, right? We just take the lines.
Yeah, exactly. And yes, you can take the whole lump up front, accelerate it. It may affect you in the later years if you need that deduction and you don't have it, and now you're paying more taxes. That's the analysis.
Yeah, that's the beauty of this, guys. Remember, we're just typing numbers in boxes, right? Whatever the accountant files goes. So if the accountant screws up, we're stuck, right? But if the accountant knows what they're doing and puts the right name on the right box, boom, you type it in. It's beautiful. Let me share right before we go and just real quick do a quick example. So I had to process this real quick. So I went ahead and downloaded. You guys saw the tax return place. The other one to go to, I have it in my guide here. Hold on, let me pull it up. So if you guys go to the tax returns, the White House here, just in case you want a newer one, I'll put that in the comments. So the only way to get 2020 and 2021 are the president and vice president, right? So I grabbed those real quick and ran them through our AI. So that's what I was doing on the other screen, trying to show you guys something. It just takes a minute. So on our site for our LOs, I just want to show you that I just went in and grabbed those. I uploaded those, the vice president, because she's got actually some stuff on there. And I uploaded those 2 returns a minute ago. It ran through our AI processing powered by Google AI, and it popped out our calculators instantly. So all that work that we just did, our loan officers don't necessarily have to do. Obviously, you still got to go line by line and verify it. But look what just popped out. So I didn't type this. You guys didn't see me typing. You saw me clicking stuff, right? So I didn't type this up. This gets popped out automatically. So obviously it doesn't read like her full address, doesn't always read exactly everything, right? But what's important is it does type numbers into boxes, right? So that's what we need to have here, is this form is going to type the exact numbers into the exact boxes that we need to start us off. Now, we can't just take this. Remember, computers are only as smart as numbers in boxes. Computers don't read that fine print. Well, maybe ChatGPT will here in a minute, but I don't quite have ChatGPT installed on this one, guys. But the numbers are just typed into boxes. We still need to, see which is declining, which is increasing, all that kind of good stuff. So it printed out one for each year. I don't know why it did that this time, but I did get a separate one for each year. So this is the one that it popped out just a second ago for the other year. If you guys go through that example and check out the White House tax returns, if you want to get a newer example. That link I had before, all those old candidates only had returns from when they ran. So that one will have your 20 to 21 so that you can use, this is the 20 and 21 version of that form, a little bit newer version, a little bit cooler looking version. So I just wanted to do that before we signed off. I guess you want me to pass it over to you, Kyle? You can wrap it up.
Yeah, absolutely. Yeah, that's great, right? So our loan officers, all of you watching, you have that automatically there through our system. You just got to make sure you upload them in the spot for the tax returns, right? You can't just upload them as a random document. As long as you're in our system and you upload them in that place of the tax returns, it'll automatically do that for you, calculate the income, just like we
I want to say it'll do it for you. I would say it'll automatically type numbers in boxes for you. So don't.
Correct. Yes, you still have to.
Right.
You still have to verify it, but it's going to give you that good start and put everything where you need to be, so you don't have to do as much manual stuff. So that's it for tonight. We do this every Tuesday night, the loan officer training, and we actually have one on Wednesday nights as well. So the next time we will see everybody is actually tomorrow night at 7 p.m. Eastern time. We have our sales training. So we're going to go through some cool sales stuff. The sales training is my favorite. So we'll get into that tomorrow. But thank you, everybody, for tuning in. We appreciate it. We'll see you tomorrow, 7 p.m. Eastern. Thank you, everybody.